Hello, everybody, and welcome to the channel. In the last month or so, there's been a lot of debate over Dave Ramsey's recommendation that you can take out 8% and still have your money last in retirement until you die. Most other financial experts recommend something well below an 8% safe withdrawal rate. Most of them are going to put out things like 3 or 4 or maybe 5% if they're really, really ambitious, but generally speaking, most recommend 4%. Well, is the 4% withdrawal rate really a 4% withdrawal rate? I would argue that it's not, and I'm going to explain why here in just a minute. This safe withdrawal rate is generally based upon what is called the Trinity study, which refers to a study done by some professors at Trinity University in Texas. And it was published, and they argued that if you had a portfolio of stocks and bonds, that you could basically take out 4% of that every year, and then your retirement nest egg would last for at least 30 years in retirement. What these safe withdrawal rates are really leaving out, though, is the effect that dividends and interest will have on your withdrawal rate. Let's take, just as an example, the Vanguard S&P 500 ETF. There are other mutual funds and ETFs that attempt to mimic the S&P 500's returns. And let's just imagine that you have $1 million in this investment at the beginning of the year. You want to then take out 4%, which would be $40,000. Now, let's keep in mind that to get to $40,000, you don't necessarily need to take out $40,000 right then. The S&P 500 fund currently has a dividend yield of 1.44%. And if we scroll down here, it is much more obvious. And that 1.44%, if you take that away from the 4% safe withdrawal rate, that means that you would come up with a withdrawal from your actual funds of 2.56%. So let's imagine that you take out that 1.44% over the course of the year. So that's going to be roughly about 1/3% or so every 3 months. And you take that out, and you can then figure out a 1.44% return on a $1 million nest egg would be about $14,000, which means you really need to take only about $26,000 out of your capital to start the year in order to return $40,000 or 4% on the $1 million. By way of disclosure, I do own a very small amount of VOO, or the Vanguard S&P 500 ETF. I also own SCHD, which is another fund that I'm going to talk about here in a minute. That doesn't mean that I'm advising you to buy that. This is just for educational and entertainment purposes, showing you what is possible to cut down on that 4% withdrawal rate and still basically get 4% of your nest egg available for spending every year. Without further ado, I am going to go into the Schwab US Dividend Equity ETF, or SCHD, which is very popular among dividend investors. This dividend-focused ETF has a current trailing 12-month yield of 3.57%, which means that over the last year, if you had a $1 million nest egg, you would have been able to take out the dividends, which roughly amounted to $35,700, which is really close to the 4% withdrawal rate and or $40,000 that you would take out with that. So in this instance, the 4% safe withdrawal rate really becomes a 0.43% safe withdrawal rate. One final example that I want to show you is VYM, or Vanguard's High Dividend Yield Index Fund ETF. And this particular ETF has a current dividend yield as of December 14th, 2023. This goes up and down, on a daily basis. But anyway, the current trailing 12 months of dividends pay out at 3.03%. So in this instance, $30,000 of the safe withdrawal rate is going to come from your dividends if you're basing it on $1 million portfolio. And if you wanted to get to the 4% safe withdrawal rate, then you would take out about $10,000, actually slightly less than that, to meet your safe withdrawal rate. Then you still have $990,000 left if the market is even flat during that year. The news actually gets even better. If we go back to VYM and their dividend summary, we can see that there's a 5-year growth rate of 5.6%. This has generally, for most of these ETFs, exceeded the amount of inflation in a given year. So your dividends are actually increasing more rapidly than the rate of inflation. And this is important to remember because the amount of money you can spend on an annual basis tends to grow because your dividend is going to tend to grow. Now, there are occasionally periods during a recession that dividend payouts can drop on a broader ETF. But generally speaking, they're going to go up over time. Even in the Great Recession, where the stock market dropped by about half, dividends only dropped by 21% on the S&P 500 fund, which means that dividends tend to be more stable than stock prices. Also, over the long haul, the stock market tends to increase in value, which is going to also impact your ability to spend more money over time. And theoretically, you should be in a lot better shape than if you just take 4% of the account value regardless. So, is it just possible to get a stock or two that have a really high yield and then just spend the dividends off of that? Well, it is. However, that could be a recipe for disaster. There are plenty of people who held GE stock and expected that to fund their living expenses for life. Well, what happened? GE dropped their dividend down to a penny a share, and those people were in a world of hurt. That's why diversification is key. If you have many different stocks or a fund that holds stocks, if one or two of those companies goes belly up and stops paying dividends because they no longer exist, then you still have those other companies who are doing well to pick up the slack. One of the benefits of taking dividends into account when figuring a safe withdrawal rate is the fact that you have to sell fewer shares from your nest egg. And when you sell shares, that means there are fewer shares that are paying you dividends. Okay. So if you hold on to those shares, you have more shares paying dividends for hopefully longer. And in years when you have dividend growth and also share price growth, theoretically, the value of your portfolio could go up. Now, this scenario is not guaranteed, but the ability to hold on to more of your shares is a lot more likely if you are selling less of them. And the likelihood of your portfolio value growing is a lot better if you're not selling all of your shares off to fund your living expenses. Again, I just want to point out this is not specific investment advice. It's just for educational purposes, and it's kind of what's going through my mind at present. So I hope you found this information educational and beneficial for you. If so, if you will be kind enough to just drop us a like by hitting that little thumbs up button. Also, if you would, and you have not already done so, please hit the subscribe button. Also hit the notification bell so you'll be informed when the next video comes online. You can also share this content with your friends if you found it interesting. And anyway, I want to thank you so much for watching. And until next time, have a great day.